So you should be seeing some super exciting gray and teal slides at the moment. So I'm a fairly simple guy. I need to think about the world in analogies, for lack of a better term. Some people love looking at data. I prefer looking at the data and then kind of thinking about it in terms of experiences and pictures. So to me, the way I'm kind of thinking about the economy right now is it's like a horse race, and they're playing the bugle as they call the horses to the start gate, right? The call to post. So I think we're not yet off to the races, but I think we're not far away from getting there. And that's kind of the way a lot of economists are viewing this. So this is gosh, I hate to say this because we say it in every email now. This is kind of a unique time, right? But for economists, this really is less a story about the economy and more a story about a pandemic and public health to which the economy is responding. So our outlook for the future depends as much as anything on what's the outlook for the pandemic and public health. We need that to normalize before the economy starts to really normalize and get rolling again. All right, so where have we been and where might we be going in the future? So if you'll permit me to, I'd like to be really optimistic today. And I think that's as we look back on what's happened over the last year, we talk about how challenging it's been and how tough it's been, but businesses have done remarkably well. The economy has held up remarkably well. I mean, we thought, not just economists, we as in all of us, thought the world was ending in like April and June. And now we're coming out the other side of it. So to share a couple of numbers with you, the Federal Reserve, which is widely regarded as one of the better forecasting organizations, in June thought that at the end of 2020, we would still be 6.5% down on 2019. So the Federal Reserve in June was forecasting that we were going to take a hit and we would still be laying on our back come the end of 2020. We ended up only being down about 2%, which is, it's not necessarily something to go celebrate and brag about, but it's much, much better than we thought it was going to be. And I think that's a testament to a couple of things. One, a policy response that was unprecedented, and two, the creativity and resiliency of entrepreneurs and their ability to figure out how to manage within the virus and adapt and rethink their strategies. And I don't think they get enough credit for having done that. All right, so I said I'm going to be optimistic and upbeat. We do need to recognize that we did take a heck of a hit and that hit was not evenly spread. So if we think about the different industries and where the impacts were, we can see that they were much, much larger in the leisure and hospitality sector than they were anywhere else. And this shows up actually if you look at the mobility data. So if you look at how much folks are moving around within the community, you see that mobility data drop a lot more in the major cities than in some of the rural areas or smaller cities. And a big reason for that is that the central core, the urban areas of those big cities are a lot of office jobs that could easily be moved to working remotely. Versus you take a New Hanover County or a Brunswick County, which is heavily dependent on leisure and hospitality, and it's really hard to do those jobs remotely. So those folks kept going to work and suffered the biggest brunt of the shutdown. So we can see that real clearly with that red bar for leisure and hospitality that shows a loss of almost half of those jobs at the peak loss during the year. But if we want to be a little more optimistic about it, we can look at the blue bar that suggests it's recovering. And we'll see this as well in a few minutes. So they took it on the chin. They haven't fully recovered. That group's still really suffering, but at least we're trending in the right direction. And I think one other point to make before we move away from thinking about these heterogeneous impacts is thinking about who this has affected within our community. So the jobs in leisure and hospitality tend to not be the best paying jobs. And if you think about the sectors that moved to remote work and folks started working from home, those tend to be the better paying jobs. So we've had this disproportionate impact on those that are most vulnerable. And we probably don't want to overlook that fact. All right, so good news and bad news. Bad news, it was rough. Good news, we're starting to put it behind us and the recovery is already underway. So what might that look like going forward? And I think in order to think about the future, we probably should think a little bit about the past and what the disturbance looked like. And then as that normalizes, what will that normalization period and process look like? So I was kind of thinking about how did the pandemic play out? And of course, if you're trying to think of how to explain something, you have to use threes, right? It's always got to be 3 words. And if they can start with the same letter, even better. And the ones that kind of came to my mind as we think about the pandemic is we went through this phase of first hoarding, and then we all went into hiding for a little while, and then we came into the helping mode. So we all freaked out at first, bought a whole bunch of stuff, then we all went to hide, and then the policy response started to hit, right? The stimulus programs, et cetera. So what does this mean for the economy and the numbers that go with that? So this is my favorite chart thinking about the pandemic. And why is it my favorite? Because it's unique. What would you usually expect in a recession or a pandemic? At least me in March, I was thinking, oh my gosh, are we going to lose our jobs? Are we going to be laid off? Maybe we should cut back our spending. The world might end. Typically, as folks get nervous and anxious, you see consumption and income fall. But this one was really unique because as we cut back our consumption at the same time is when all these stimulus checks from the federal government hit. So what we saw in April of 2020 was a record increase in income as we shut down the economy. So if you think about what that means, we've got a large inflow of funds in the people's houses. And while we're all staying at home, a very small outflow, which means that savings hit a record level. So the US savings rate tends to be somewhere around like 7% recently, and you got up over 30% for a while. So households saved a lot of that cash simply because they didn't have anywhere to spend it. So what does that mean for us going forward? Well, it means that households are now, at least a lot of them, still sitting on a pile of cash. Now realize this is an overall aggregate number. The folks that are in leisure and hospitality are probably not sitting on a pile of cash, but the office workers that went home still continued to receive their paycheck, cut their expenditures, and receive stimulus checks, have funds. Shoot, I can see it in our students. What are our students doing with stimulus checks and money? They're now playing around in Robinhood. It used to be that before class, they were all on Facebook. Now when I walk in and look over their shoulders, it's nothing but trading accounts. I don't know if that's good or bad, but it's certainly a strange change around this place. All right, so households are sitting on lots of cash driven by these savings. So where is that gonna go over the next 6 months to a year? So I think the way to do that is let's take these consumption expenditures and let's break them out. Let's think about where we've spent our money and where we haven't, because that might show us where we're going to in the future. So if we focus only on the consumption expenditures, We see the big hit of the pandemic, but it becomes a more interesting story when we start to break out the pieces of this. So if we break it out into roughly 3 buckets, so non-durable goods, which are what I think of as sort of daily purchases. This is the stuff that we're going to buy and use. Durable goods, so your big ticket items, and service expenditures. So if we look at our daily purchases, the non-durable goods, again, this is the econ nerd in me coming out, it's really neat that you can see the spike in March of all of us hoarding, right? That's a lot of toilet paper being sold. That's that little blip up that you can see. And then you see all of us hunker down and hide. And with time, we went, oh, this thing isn't actually going to kill us every time we walk out the door. If we wear masks and follow the guidelines, maybe we can start shopping again. And my Amazon Prime account works really well. So we started spending money again come April and May, and those purchases have largely normalized. And what are we spending those extra dollars on? So a lot of those extra dollars then went into the big ticket items. So you can see we didn't hoard washing machines and cars and televisions, but once the cash started to pile up in our checking accounts, now replacing that old washing machine looks like a good idea. Maybe a new kitchen table. We're buying some of those big ticket durable goods items, especially with windfall funds like a stimulus check that you weren't expecting. So folks are using those to buy these bigger ticket items, which has had some effects. So for me, especially as a cyclist, the bike stores got wiped out during the pandemic. I went into a Dick's Sporting Goods and I was like, are they even in the bike business anymore? They had taken all the racks down. And it's not just bicycles, right? It's a lot of those hobby expenditures that we spent that money on. So you've got a situation where the demand spiked at the same time that the supply chains were being disrupted. So the stores are now lacking inventory. And it's not just bikes, it's other areas. So that's going to provide some lift going forward for the economy as we simply try to refill the store shelves. We've seen home prices go up as well for many reasons, some of it being people moving out of the downtown areas and the urban areas, and some of it being that the millennials were slow to form households and buy houses, and this was sort of spurring them forward to do that. So we've seen home prices go up in response to a really large demand shock for homes. Now, there's a big debate about, does that reverse? Are the cities dying or dead? Are people going to move back to downtown? My gut is that yes, they probably will. Because if you think about the location decision, why would you want to live in a densely populated downtown area? Well, because it's kind of neat to be able to walk to restaurants and walk to the bar instead of a really expensive Uber ride and see your neighbors as opposed to everybody pulling in their garage and not knowing who they are. But during the pandemic, those benefits all disappeared, right? So you only had the costs of living in a densely populated area, such as a small apartment you're living in, which means that these single family dwellings in the suburbs look really attractive. Like, well, why are we living here? Let's go live there where there's more space, especially if the kids are home all the time. But once things start to normalize and those benefits of living in the denser areas come back, I expect a lot of folks will move back. So we're going to see some normalization there. But there's also an awful lot of fuel for growth going forward. So what's going to continue to support the housing market? Well, interest rates are expected to remain low for the foreseeable future. And households are sitting on a really strong wealth position. They've got cash in the bank still, and their stock portfolios have done pretty well. So there is definitely fuel to drive growth going forward. Now, how long will interest rates stay low? How long is Jerome Powell going to continue to shower cash on the economy is a huge question. But the Fed right now, if you sort of look at the median forecast from the committee that sets the interest rate, they think it's going to be at least 2023 before they start moving the federal funds rate up and we start to see other interest rates really make significant increases. So why so long? Markets tend to think that the Fed is going to raise interest rates sooner than the Fed actually does. And now there's been a shift in the Fed's thinking where the Fed is talking about keeping interest rates lower for longer and letting inflation potentially run a little bit higher than it has in the past. And the reason for this is when you start to break down the benefits of growth, those benefits accrue to the high earners first and to the low earners last, which means the longer the Fed can let the economy run, the more benefits there will be on the lower end of the income spectrum. And they're starting to focus on this. So this is like a big shift for the Fed in the way they talk about policy going forward. So they're talking about being more accommodative than they have been in the past. And they tend to have been more accommodative than markets thought they would be. All right, so what does all this hoarding of items and buying big ticket items mean for us as we start to go forward and reopen? Well, what's still missing from this story? It's the service expenditures, right? It's the fun. It's the going to concerts and going out to eat. We have bought an awful lot of physical stuff, but we have not bought very many experiences over the last year. That's the piece where I think we're going to see a big rebound, probably a month from now, 2 months from now, as the vaccines roll out and restrictions continue to be relaxed. We're going to see that demand for experiences pop back pretty quickly. I don't need any more televisions. I need some socialization. And my wife wants me out of the house. So we need to go do something. And that's going to drive a pretty big summer for us here, I think, as people come to the beach and go in search of those experiences. All right, so back to our story a little bit about where have we come from and where are we going? Is this pickup actually on the horizon? If you look at the standard measure of unemployment, the U3 rate, the one that they talk about an awful lot on the news, it's recovered fairly strongly from its peak back in April. But the problem with the standard unemployment rate is who gets counted as unemployed. So in order to be counted as unemployed, that means you don't have a job, but you're looking for one. So a lot of folks that are in leisure and hospitality have lost their jobs in this pandemic. And since a lot of those operations are still shut down or only running at partial capacity, they're not even looking for employment at the moment. So they're not counted as unemployed. So we have this sort of group of shadow unemployed, for lack of a better term. They actually get categorized as not in the labor force. So if you start to add those folks back in, the more realistic picture of unemployment is that we're probably running somewhere around like the 9.5% range still. So there's a lot of labor sitting on the sidelines, ready to support this expansion as we open back up. So there's financial fuel for the fire, the fuel the demand side, and there are workers on the sideline, which can help with the supply side. So what evidence is there that there's a pickup on the horizon? Well, one piece of evidence is that the number of hours worked per week, or the average number of hours per week, has grown faster than employment has. So that means the folks that are working, we are loading the mule, right? Give them more, give them more, give them more. Sooner or later, those folks are going to crack and businesses are going to have to hire on that next marginal employee. So I think that there's a hiring pickup on the horizon that goes along with the reopening. So looking forward, what's going to give us this lift and drive growth going forward? A piece of it are these lean inventories that have to be rebuilt. We've got to stock the shelves again. We've got a dollar, which is supportive of export growth, although that fluctuates pretty quickly. We have a quickly improving public health situation, at least in the US. The rest of the world isn't quite keeping up with us, but the US is making pretty good progress. We have strong wealth positions of households, and we have favorable financing conditions. So all of those things point towards economic growth. Where will the drag come from? And this list keeps getting shorter, which is really fun to delete stuff off the list, right? So the drag we used to think was going to come from a public health problem. Well, that's starting to move behind us. There were a lot of questions about consumers and how apprehensive will they be about coming back out. Anecdotally from Texas, it sounds like they're coming back out pretty strong. The rural areas here, you can tell people are done with the pandemic. So I went to a small gas station with a grill attached to it, a little bit outside of town. And there were about 6 people working the grill and about, 10 people eating burgers or BLT sandwiches in there. And not a single person had a mask on. And that was my indicator that folks are tired of this thing. So as we reopen, they're going to come back out. So the consumer apprehension kind of put a strike through that one. It looks like folks are going to come back out. There are still some concerns about small businesses that are just barely clinging on. What do their balance sheets look like? And what is the possibility of credit losses for banks and financial institutions look like as these different forbearance measures start to go away? So there's still some concerns out there, but the list of concerns is getting shorter. The list of drivers of growth is getting longer. So looking forward, I talked a minute ago about the Federal Reserve keeping interest rates lower than they probably would have in the past. So let's spend a minute thinking about this because it's potentially really important. So the Federal Reserve has a dual mandate. They're charged with 2 things: trying to ensure maximum employment and stable prices. And they define stable prices as being 2% inflation. But they've fallen short of that over the last year and a half or so. So the Fed is now talking about averaging 2% inflation. So they call this thing FATE, Flexible Average Inflation Targeting. And that's a jargony way of saying, since they didn't quite achieve it, inflation was lower than their target for a while, they're going to let it run above target for a while. So they're going to try and do some catch up so that over time they average this 2%. So how do they get prices to increase? They do that by continuing to have accommodative financial conditions and keeping interest rates low. So that's part of the story of why they're going to keep rates low. The second part is that they're starting to focus on these different sectors of employment, right? Or different groups of employees, and thinking about this inequality of wage growth. So this is a chart from Jerome Powell, the chair of the Fed and the FOMC. And as he was talking about it, he was talking about this dotted black line that you can see falls and stays low while the other lines start to rise. What is that dotted black line? That is wage growth for the bottom quartile of employees. This is the issue of growth reaching the folks on the lower end of the income spectrum last. So think about why that happens. As the economy starts to grow and we start to hire, which positions fill first and which employees become in short demand quickly? It's those with really specialized skills, right? I mean, in the real estate world, you probably see this right away with trying to find the good trades folks. Good luck finding a quality plumber or carpenter when the market's cranking along. But what about the low skill manual labor? There are an awful lot of folks that can do that. So those are the last ones to see the markets and constraints start to bind and push up their wages. These are the folks on that low end of the income spectrum. So they see their demand and wages go up last. And the Fed is saying, wait, maximum employment doesn't just mean employment for those with college degrees and specialized skills. Maximum employment means employment for everybody. So let's keep watching this lower quartile group and see if we can move that number. So they're focused more on it than they have been in the past. All right, so looking forward, Federal Reserve likely to maintain favorable financing conditions with their flexible average inflation targeting, which is just a long way of saying, hey, we're going to let inflation get a little higher than we otherwise would have so that we can get some growth on these low wage jobs. Other pieces that will drive us going forward is we've got a Washington, D.C. that is now run by a single party and tends to be stimulus minded. And we think that as the economy, as the public health situation improves, so will the economy. So the V-shaped recovery, probably as much as anything, now stands for vaccine. As those roll out, that's going to drive the growth going forward. So in Southeastern North Carolina, we're probably going to see a fairly similar pattern, but maybe a little bit different. So obviously, if the nation isn't doing well, we're not going to do well. And if the nation is doing well, we're probably going to do well, but not necessarily at the same rate. So the local economy is likely to follow the trends of the nation, but with some differences. And where do those differences come from? It comes from the composition of our employment and industry here. So what is driving Southeastern North Carolina? Well, if we look at the industries that are strong here, we're strong in construction and strong in leisure and hospitality. A little bit in trade, transportation, and utilities in Brunswick County. That's driven mostly by the power plant over there. So if you think about which are the two main industries that drive us, it's going to be construction and leisure and hospitality. And the leisure and hospitality is the industry that has the most space for growth, which means we've got a lot of space for growth here in Southeastern North Carolina. So that bolded green bar is leisure and hospitality, and you can see the shutdown, the partial recovery, but the large space left to go because we can't go to concerts indoors yet and a lot of these other fun experiences. So what that means for us is that unemployment rates here popped up a little bit higher than the rest of the nation. It's really clear in Brunswick County. In New Hanover County, the unemployment rate didn't go up as high because we sent a lot of our workers home when we sent the college students home in March. So that at least helped offset some of these losses in leisure and hospitality employment, is the folks that would have been working there went back to other places in the state. But again, we've been pretty resilient. If you start thinking about the leisure and hospitality industry and our folks willing to come here, there was the initial freak out that we can see in that blue line. So that blue line is room occupancy tax receipts for Brunswick and New Hanover County tallied together. And we see that people were nervous in March and April. And then apparently we can only spend about 6 weeks at home before we're climbing the walls, and folks started to come back to the beach again. Since then, those room occupancy tax rates have held up pretty well. Sales tax receipts, or at least taxable sales, are up about 2% over last year. So sales tax revenues have held up pretty well, which is supportive of the local governments. So there's a lot of stuff going in our direction. So to sort of wrap up, I, again, need to put a whole bunch of disclaimers on this. I am not an epidemiologist. I am not a political scientist, so who knows what happens in DC. I am not a psychologist. People seem to be getting more comfortable coming out again, but cases are on their way down. The restrictions are being relaxed. Consumers seem like they're getting comfortable coming out again, which to me makes me think that the horse is in the gate and we're ready to go. So I've probably been talking much longer than your attention span is. I apologize for that, but I would like to open it up to questions, comments. What are you seeing? Let me know.
Well, I'll lead the charge. I have a question for you. The business that I'm in is in real estate development, and we focus on hotel development. And I was successful in opening 2 hotels during the pandemic. However, their occupancy was very low, 20 and 30%. And we do work with a group of folks that also own a management company. So I get to see their trends. And like your slide showed, our hotel that was built in Sneads Ferry, which is somewhat of a beach town, that one held steady through most of this. Others are starting to come back now as people are starting to become more comfortable. But my question of you is, what do you see or what can you forecast in regards to business travel? A lot of the hotels that we build, we do focus more on business travelers versus leisure, depending on the location. So any input on that?
Yeah, that's a great question, because anecdotally, I've heard a lot of the same thing, that even the hotels that have done relatively well, they've seen their customers shift. It used to be business travelers, and now it's leisure travelers on the weekend. I think business travel is going to come back, but it's going to be slower than your clients are going to want, for 2 reasons. One, at least for, say, the university, a lot of our decisions are made by folks in positions where it pays to be risk averse. So they're not going to be eager to approve travel anytime soon. I assume that's true for many larger businesses. And the other reason I think it's going to be a little slow is you've got a lot of managers who are now questioning, can we do those sales and meetings through Zoom as opposed to the face-to-face meeting? I think the answer to that is going to be a resounding no, but with the cost differences, everybody's going to want to explore that for a little while. So why do I think that answer is no? If you think about calling on customers, you've been able to do that in the pandemic through Zoom and video calls because everybody else is doing that. But afterward, that might work right up until your competitor shows up on your customer's doorstep and makes that personal touch. And once that starts to happen, then everybody's got to go back out and start getting involved again. So I think that travel will come back, but it could be middle of the fall maybe before we really start to see it. I don't have a good model for it, so your guess is as good as mine. But I think it's going to be slower than your folks are going to want. Most of the travel right now is probably going to be driven by leisure travel.
Oh, and we anticipate that as well. I have another question, because again, all of us are in some form of commercial real estate fields. What about, because we sent all of our people home and they're working from home and doing Zoom meetings and that kind of thing, what do you see happening with office space? Any thoughts on that?
I think it'll follow a similar pattern of folks are all going to end up back in the office. It's just a question of how quickly. And the reason I think that is because I'm I'm a simple guy. So how do I think about the future? I think about the past and why was the past the way it was and what's changed. So pre-pandemic, we had a lot of these tools. We had the ability to have conference calls, which aren't all that different from talking to a Zoom screen full of black boxes, right? As everybody turns off their cameras. So why did we go to the office before the pandemic? And I think the reason is because an awful lot of good ideas and creativity is collaborative. It comes from the chance encounters. It comes from a conversation in the hallway where you have a creative idea. So the business case, I think, is there to bring people back to the office as they realize, oh yeah, we lost all that. A good example of that from here is we had a school-wide faculty meeting late in the fall semester, and we cranked through all the curriculum discussions in about a half hour, which usually would be like a 4-hour slugfest. And everyone was like, "Ooh, that was painless. We should do it this way every time." And then slowly the complaints start coming out. Oh, we didn't talk about this. We didn't talk about that. And you realize the little side conversations that happen in person that then lead to the bigger comments and discussions don't take place on a Zoom call. And I think that's going to drive people back to the offices. But a lot of businesses are right now trying to figure out how do we avoid that expense. So
Right.
It'll take them a while to recognize that.
Well, and I had heard too, different people who are in the office property management industry indicating too that where there will be some reduction potentially in space and some space being given back to the landlords. But in other cases where we used to have large spaces where people worked to encourage that collaboration and that kind of thing. But because of COVID, that potentially there would be some expansions in office spaces so that we could now start to separate the employees a little bit more, give them a little bit more private space and that kind of thing. I don't know, you have given any thought to that? You see any?
I would imagine that the budget manager is going to forget about public health and safety 6 months from now and only look at the cost of expanding that space.
Sure, that's true. I have one more question, then I'll let everybody else ask their questions. But what are your thoughts on, particularly, the leisure and hospitality industry as they're struggling to get back? But now there's a lot of talk of increasing the minimum wage and that sort of thing. And how does that impact that industry, or do you think it will impact that industry even further?
Oh, I hate to say something on a recorded call that might be controversial, but I think now is about the worst time to raise the minimum wage. A year from now might be another discussion, but you've got a lot of folks that have been out of work, and you've got a lot of these small businesses that are just trying to hang on, and we're talking about raising their costs. From a strictly economic standpoint, there's a big trade-off with raising the minimum wage, and that's that it really helps the folks who see their wages go from $7.25 an hour to $15 an hour, or from $10 an hour up to $15 an hour. That's a big boost for them. But the trade-off that often gets overlooked is this is really hurtful to those who lose their jobs. The Congressional Budget Office's estimate is that you've got about 1.4 million jobs that'll disappear if we raise the federal minimum wage to $15 an hour. And how does that happen? Well, it happens through putting technology in place of where you've got employees or reordering a process. So if you're a fast food restaurant and you've got the soda machine behind the counter, you've got to pay an employee to do all the refills, right? And the benefit of paying that employee to do that is people don't come up and ask for as many refills, so you don't have as much soda cost. But if that person becomes more expensive, and now they're more expensive than the extra soda of people refilling their cups themselves, you just move the drink machine out front and eliminate that job. How do you do it in, say, leisure and hospitality? You do it through an increased emphasis on technology. I still kind of prefer to talk to people when I travel, but I was able to get in and out of a Hampton Inn not talking to anybody, using their automated check-in process and their key, and that's pretty amazing that they figured that out. So now maybe you don't need 3 people at the front, maybe you only need 2, and those numbers start to dwindle. So who gets hurt by that? Who are these employees that tend to be minimum wage? Well, it's often young employees and relatively inexperienced employees. So I joke with my students that you work for minimum wage until you can prove that you show up on time, well-dressed and sober. And once you've done those things, you get bumped up off of that, right? And the problem is if we raise the minimum wage, we take away that first opportunity for a lot of these folks to prove that they can do that and to pick up the softer skills of their first job. So it's not a perfectly clear answer that we should raise minimum wage. There are trade-offs to it. Now, how you weigh those trade-offs is very much up to you all as individuals and members of society and ethical people who care about other people and have empathy to try and think about, well, which one of these options do I prefer more? So you got a longer answer probably than you wanted.
No, I appreciate that answer.
As diplomatically as I can, get both sides and dodge the question a little bit, but it's not going to help those businesses that are struggling if we raise their costs right now.
Understood.
Which of course then sounds like me being opposed to it or trying to just push it down the road. And that's really not it. It's just in order to make a good decision, you need to think about all the different impacts and then make the best decision you can.
Sure. I have one more question. Since I am in the construction business and we've seen the cost of goods go up astronomically. The supply chain has certainly tightened and the cost of lumber has gone up dramatically. We hear every day that there's product sitting on ships off of our coast. They're docked out there waiting to get to port, but because there's not enough people in port to offload this stuff, ships are sitting and the supply and demand just keeps pushing pricing up. Any thoughts on that recovering anytime soon? And we start to see the cost of construction materials start to stabilize or come down?
I haven't looked at construction materials closely enough to give you a good informed opinion. I think part of that is going to be waiting for the stimulus that we've sent out and these enhanced unemployment benefits to kind of work their way through, because there are an awful lot of folks that say, well, why would I go to work for that if I can stay home for this? And I fully understand the reason why we did it, but this is the trade-off now of you're missing some of those folks in the labor force, and that's going to cause all kinds of disruptions. One of the things that at least I really saw during this is how complicated the economy is. I mean, I kind of knew this before, but it's when we do one little tweak, we don't think about, oh, wait, if we push here, that messes up stuff over here, and you get all these unintended consequences out of it. And this is a perfect example. You've got not only the demand side shock going on, but you've got these international supply chain constraints, and you've got a labor force shock going on from the stimulus and unemployment that we sent out. And they're having some unusual effects for sure. So I think the quicker that runs its course, the quicker things get back to normal. But that may also require the rest of the world to catch up with vaccines, and they're a long way behind. I mean, I just sort of naturally assume that Europe is similar to the US, and then I start seeing notices about bike races that are going to be canceled because they're going back into lockdown. I was like, wait, what? And if you go and you look at the vaccine rollout, man, the US is ahead of the rest of the world by a lot. So it's not until really we get finished and then start sending those vaccines to the rest of the world that they can start working on the billions of other folks that need them. So it's probably going to be at least end of the year before the rest of the world gets back up close to speed again. Your lumber costs are probably going to stay high for a little while longer.
That's what we're hearing.
Sorry.
Yeah, that's what we're hearing. So other questions? Anybody have any other questions for Dr. Jones?
Hey, thank you for being here, Dr. Jones. I heard you, I think the last time you were here too. Always very helpful, but I'm in economics.
You were willing to invite me back?
We were. One of my clients has been doing a lot of research on in-migration patterns. They're a big Sunbelt investor, and of course they are doing work to make sure that they can document why they are a big Sunbelt investor. But I've been on a lot of interviews with them. I do PR for them, and talking a lot about how during COVID, the trends just solidified on Sunbelt. So they're also very carefully saying that doesn't mean, because media wants to jump to this, that it's the death of the big city at all, but that the Sunbelt trend continues. Has Wilmington, do you agree with that? And has Wilmington benefited much from, I know it's not one of the main in-migration pattern cities, but has it benefited?
Yeah, so I agree that a lot of those trends solidified. I'm not willing to declare the end of the city. I think we're going to see a big shift. So you have a lot of folks say, oh, New York's dead, everybody's moving out. And I'm thinking, man, there are a lot of folks that wanted to live there before and couldn't because they either couldn't afford it or there was nothing available. So you're going to have this shift of folks coming out, but then that next wave is going to come in. So it wouldn't surprise me if a lot of these cities become younger in age as you see this turnover happen. As for Wilmington, I don't have great data on it yet because it's lagged heavily, but I think we've seen a fair number of folks move here for a couple of reasons. One being if they can work remotely, they said, cool, this is our opportunity to go check out and live somewhere else. But I think that sets us up for a real issue going forward of as these folks get called back to the office, do they go back or do they start looking for work here in Wilmington to try and stay? So if they're here for, call it 6 months to a year now, and maybe it's another year before they're forced to make a decision about do they go back or not. 2 years is a long time for kids to start making friends and putting down roots. And I think that's going to encourage a fair number of them to look for employment here. So the challenge for us will be how do we absorb them into the local labor market and in the jobs here. So I think it's been good for Wilmington. I think it has the potential to be beneficial still going forward as that talent transitions from simply living here to actually working here as well.
Thank you.
Other questions?
Dr. Jones, I have one for you. So you talked about interest rates are presumably going to stay low for a while. Can you talk a bit about how you think that's going to affect housing? For, I imagine if interest rates stay low, that people are going to want to buy. There's already kind of a supply demand issue there, and how that could affect house prices as well as apartment complexes as a whole with their demand going down.
Yeah, I think it will help the support housing. I think a lot of the housing market ultimately is driven by people's incomes and their ability to pay for a house. And the current situation has pushed a lot of people to stretch that and think a little bit bigger. If you're homeschooling or working from home, a small apartment doesn't look attractive. And I think as the world starts to normalize, that piece of the demand is going to come off. And we're not going to see home prices continue the rise at the rate they've been running at. But low interest rates will help support them where they are. So I think there's some downside risk in home prices over the medium term, but that the lower interest rates will help offset that. Where we've seen a big impact from these low interest rates is on households' debt service levels, right? So a lot of refinancing and people taking advantage of the opportunity to increase their disposable income, maybe even more so than driving demand for housing. So I guess to get back to your question, you said, what's going to happen to housing going forward? I think it reverts back towards a more normal pattern. Now, Southeastern North Carolina, sort of mirroring the last question, has not seen as large of a run up in home prices as some other places in the country has. But we were outpacing the US beforehand, and then this thing hit in the US and the US then went past us. So there may still be a little bit of room to run, but I think that housing starts to normalize over the next year or two.
I had another question too about your students and unemployment or employment. Are we finding new graduates are able to find employment during this time?
They've really struggled. A lot of them are working retail and other jobs while they search for what they actually want to do. They've struggled.
Okay. Yeah.
We've also seen a lot of our students taking remote classes because they have employment opportunities at home, either because that's a bigger city or it's because that's where their network is. And they've been able to find opportunities there, but not in Wilmington. So they've opted to stay remote.
Wonderful. All right. Any other questions for Dr. Jones? No? All right. Well, thank you. I really enjoyed this. I'm sure the rest of our attendees have enjoyed it as well. We appreciate your insight and appreciate your willingness to join us for lunch.